The goal today is to jump into and talk really briefly about net value. Most people, when they are going through any type of ownership transition, are focused on gross, the value that is on the purchase price. But if we're not careful, things like taxes and fees can take a $6 million gross and turn it into a $3.5 or $4 million takeaway. That's real money out of your pocket. And we want to talk about some advantages to different transition strategies that will help you keep more money in your pocket. Just as an overall beginning, succession planning is something that needs to be done over a long period of time to prepare your business for the transition. And you need to find the right group of advisors to lead you through this process of valuation, goal setting, structuring the deal, and understanding all of your options and whether or not they're going to actually accomplish your goals. At Stratus, that's one of the things that we do. Our goal is to keep independent businesses independent. And we do that by helping them understand the value of their business through in-depth certified valuations that will stand up to IRS and Department of Labor scrutiny, and then working with them to make sure that their goals are carried out and their net worth is protected. So let's jump into a discussion here of what are some of the options besides what most owners look at and go, geez, well, my kids don't want the business. Guess I'll just have to sell to a third party. Well, that could be an option, but what we want to talk to you about today is that there are other options. There are other ways to do this, whether it's to a key employee or one of those three strategies at the bottom that will really help keep independent businesses independent. So let's walk through a quick case study here. What we see a lot is a case like this. We have a multi-generational family business that's big but not huge. Could M&A be a possibility? Absolutely. But is it the only possibility as most owners think? No. And we'll show you the difference on the next couple slides from a financial standpoint of going with the outside buyer versus using an internal option like an employee stock ownership plan, worker-owned cooperative, or perpetual purpose trust. So when we sell to an outside buyer, this is what is considered an asset sale. An asset sale is when an outside buyer says, we don't want any of the liabilities or the debt. We just want your operations. What happens in a C corporation is that you're going to get taxed twice. First, you get taxed at the corporate level for the gain on the assets that were sold. Then you get taxed again when those distributions are made to the individual shareholders. What happens if you sell to an ESOP, let's say? That's a stock sale. Stock sales are taxed at long-term capital gains rates. Top rate is 20%, plus whatever the rate in the state may be. Compare that with a 37% top rate for ordinary income, plus whatever state taxes there are. And you can see that there's quite a large difference. You then go down and you look at what are the fees? What are the fees I'm paying? Most outside transactions include some type of M&A banker or broker. And while that broker is not charging you maybe an hourly or retainer fee along the way, they are taking a cut of the ultimate sale price, which puts less money in your pocket than if you had just used some advisors and written them a check along the way and sold internally. And in this example, we're talking about over $900,000. That's over $900,000 that could have been in your pocket that has now been paid to the government and to advisors. What happens if you have an S corporation, right? This removes the double taxation, but what it doesn't remove is the tax inefficiencies that can crop up in an external sale. When you sell the business externally, there's this tug of war between the buyer and the seller and how they want to allocate prices. Most of the time, the buyer is going to win that, and they are going to allocate towards assets that help them but hurt the buyer. AR, inventory, fixed assets. These are things that the buyer is going to have to pay ordinary income tax on, as opposed to long-term capital gains. So imagine if 75% of the sale was taxed at a max rate of 37%, whereas if you sold to a worker cooperative or perpetual purpose trust or an ESOP, 20% is the top rate. That's a big difference, 17 percentage points. And it shows up here again, because once again, we're still selling the same business for the same price. We're even going to say, if we get a little bit of a premium of $150,000 to sell externally, we're still going to end up with over $330,000 more dollars in our pocket by doing the planning and selling to one of these internal structures that will get us more money because there's less that we are paying externally. What are some of the other benefits here? We saw how taxes and fees can really impact this. But let's think about ESOPs, worker-owned cooperatives. There's something called a Section 1042 exchange, which allows you to defer paying capital gains. And if you don't need that money, you can hold it until the owner dies. And then their heirs get a step up in basis and essentially pay little to no gains taxes on that money. Cash balance plans can be great on these internal sales. They allow the owners to put away a lot of money up front. It reduces the tax of the business. It removes equity from the business and puts it in the owner's pocket before a transaction. And it allows that money, to the tune of over $100,000 a year in lots of cases, to grow tax deferred. Right? These are just two of the examples that I think people need to think about and are important when you're planning your transition. Another benefit is control. If I sell internally, I have control over when and how I move those shares. When I do it externally, I'm going to sell 100% of the business. I'm going to lose a lot of negotiating leverage, and I'm going to be taking quite a bit of risk in the deal, including something like an earnout, where I'm not going to get a guarantee on a certain percentage of the deal unless we hit performance targets, right? Compare that with an internal sale where I could sell 30% every couple years. And not only am I controlling the process and I can be more tax efficient, but I can appreciate my value that I'm taking out of the business as the business grows. So lots of opportunities to be flexible here on the internal side. Finally, let's take a quick look at this slide. It's busy, but two things I want to draw your eye to. The top line, fair market value. Everybody can get fair market value from selling to an ESOP, co-op, perpetual purpose trust. It's the same thing that you can get from selling to an outside buyer. Now let's look at the second line. You have to do very good tax planning just to keep your head above water if you're going to sell to a financial buyer. Whereas these other three stock sale options have built-in tax efficiencies to keep more money in your pocket. So we wanted to end there. We hope you found this useful introduction to some other ways, employee stock ownership plan, perpetual purpose trust, worker-owned cooperative, that can lead to you walking away with from a deal with more money and having more control during the process. Think about it. Go to our website, use this QR code, give us a call. We're happy to have a complimentary conversation anytime you want. We appreciate it. Take care.